So Anthony, when you and your team at Veritas look at a company, what are the 5 key things that you pay attention to?
First is accounting and disclosure. So look for how a company reports its results, reading through the details of the accounting policies. Then we look at the balance sheet. So what assets are included, what assets aren't included, what liabilities are included, what are not, what equity should be equity, what should be liability, etc. Then we look for cash flow sustainability. Okay, and we discussed already all the secrets to the cash flow and how it's not just operating cash flow less capex. Then we look at the business model, and with the business model, you're looking for what is it that's the pinprick that will break the business from working. And so I like to think about, in the case of Valeant, it was when it can't continue to raise prices. That was it. If it couldn't buy something and raise the price, it no longer worked. And the last and not least is corporate governance. So how's management's getting paid? Is that congruous with the desires of the shareholder base? What's management's record of making decisions? Acquisitions, capital investments. That really, I did a study, I wrote one of the first reports I worked on back in 2000 was on Bombardier. And that's really a story. The stock was near $20. We said sell it. We were threatened with a lawsuit. The stock is virtually penny stock and has stumbled through being a penny stock for the last 20 years, essentially. It's a very sad story. But what was really evident in the early days in the financial statements of Bombardier, and we wrote a case on this too for Ivy, was that when you see a company, every accounting choice it makes is on the side of being aggressive, on the side of making earnings higher, on the side of making revenues higher. You don't know exactly that something is happening or not, but you know that their bias is to make things look better than they otherwise are. And that's extremely dangerous.